Every March, millions of people chase an RRSP tax refund as if it were a windfall, often ignoring the mechanics that make it possible. The RRSP is a tax-shifting instrument. Contributing pre-tax dollars drops your taxable income, reducing your current tax bill. Inside the account, capital compounds tax-free, but the government eventually collects. At retirement, every dollar withdrawn is taxed as regular income. The math relies on a tax bracket differential. If you withdraw funds at the same marginal rate you were in when you contributed, the net tax advantage is zero. There is also a permanent cost to using an RRSP for short-term savings. If you withdraw money for an emergency, you lose that contribution room forever. You cannot simply put it back later. If you want to see more mechanical breakdowns of the financial system, like this video and subscribe to the explainer. Using an RRSP without a chronological strategy often eliminates the tax benefit. In these cases, time, not just the dollar amount, dictates the actual value of the account. For a young earner in their 20s, the financial timeline is just beginning, with decades of potential compounding interest ahead of them. However, the RRSP is often inefficient at this stage. Because entry-level incomes are low, the tax deduction generated by a contribution is small, providing very little immediate relief. For this bracket, the tax-free savings account is usually the superior priority. It offers the flexibility to withdraw money for travel or emergencies without the tax penalties associated with an RRSP. There are only two common exceptions: capturing a guaranteed employer match or using the home buyer's plan to put up to $60,000 toward a first house. For most young professionals, lock-in capital into an RRSP is an uncompensated risk that sacrifices liquidity for a negligible tax break. A decade later, earners enter the mate-to-rear grind, where rising salaries meet the friction of mortgages and the costs of raising children. As income rises into higher brackets, the math changes. Contributions now shield dollars that would otherwise be taxed heavily, resulting in much larger tax refunds. The strategy here involves making modest placeholder contributions to manage immediate life costs while preparing for your peak earning years. This decade is a transitional phase where the focus shifts from pure growth to active tax shielding. Eventually, earners reach their peak earning years, which often represent the highest tax bracket of their entire lives. This 15-year window before retirement is the optimal time for aggressive RRSP contributions. Every dollar contributed at this peak marginal rate extracts the absolute maximum tax savings possible from the government. Even though retirement is closer, there is still enough time for these tax-shielded contributions to compound before they are eventually withdrawn. Success with the RRSP requires timing, using this specific chronological window of high taxation to maximize your leverage. At age 71, the RRSP reaches its mandatory expiration date, and the government forces a change in the account structure. You must convert the plan into a registered retirement income fund, which requires you to take taxable annual withdrawals whether you need the money or not. These forced withdrawals can push your income past specific thresholds, stripping away government benefits like old age security through a process known as a clawback. Upon death, the entire unconverted balance is taxed as a single lump sum on the final return. This often pushes the final tax bill into the highest possible bracket, as the government treats the entire account as income earned in a single year. The efficiency of the RRSP depends on one specific calculation. You must contribute during high-income years and withdraw during low-income years to keep the tax savings. Log into your CRA My Account to check your exact contribution limits and avoid penalties. This breakdown is for educational purposes and is not licensed financial advice. Drop your current age and income bracket in the comments to debate whether you should be prioritizing the RRSP or the TFSA right now.